All right, dear students, we are going to start IAS 16, which is property, plant, and equipment. And in your earlier accounting paper, when you were studying the types of asset, you studied two main types of the asset. And those were non-current assets and the current assets. And then you made the differentiation between these two, that current assets are also known as the liquid assets. These are easily convertible into cash. And the entity is going to realize these assets within 12 months. And the examples were the receivables, the cash, the bank, and the inventory. These were the examples of the current asset. And then you discussed the non-current assets, that these are the assets which will be providing the benefit to the entity for more than 1 year, or the life of these assets are going to be more than 1 year. And we are not going to sell these assets in the ordinary activity of the business, in the ordinary course of the business. These are the assets which are not for resale, although we can sell these assets some point in future. But the objective is not to sell these assets in the ordinary activity of the business. And these assets are going to be used within the business. The examples were, for example, the land, the building, the plant, the machinery, the vehicles, etc. But in your earlier accounting paper, you didn't study that why the land is being held within the business. Did you buy it for the appreciation, that you want the appreciation in the value of the land? Or for example, is the land which is attached to the entity's building and the entity is using that land for the business? You didn't study the objective of this building. Is that the office, or you have given that building on the rent? Similarly, you talked about the vehicles. Are these vehicles being given to the people on the rent, or you're using it for staff pick and drop? You did not study the objective of these non-current assets. And in fact, when you used to hear the land, you used to tell, okay, this is the non-current asset, the building, the non-current asset, based on the concept that these are the assets which are not being sold in the ordinary activity of the business, and the life is more than 1 year, or something you were having in your mind that, okay, these are the assets for the business use. Now you are in the financial reporting exam. And here, when you talk about the assets, there are many standards in which we are going to classify the assets. For example, you talk about IAS 16. This is the asset standard. You talk about IAS 40. This is the standard again, which discusses the assets. You talk about, for example, IAS 38. It belongs to the asset. You talk about IAS 41. It belongs to the asset. You talk about IFRS 9 financial assets. Again, it discusses the asset. So you need to understand the scope of every asset so that you can classify that particular asset or those particular assets in the correct standard. Let me give you an example. For example, you talk about the land. Now, it can be for the business use. It can be held for the appreciation, or it can be a non-current asset held for sale. Now, when you talk about the land which is held for the business use, this is being classified in a separate standard. When you talk about the land which is being purchased for the appreciation purpose, that means it is going to classify in a separate standard. When you talk about the land which is being held for sale, then it is going to be classified in a separate standard. So when you talk about the financial reporting exam, then you need to understand the scope of every standard so that you can classify the correct standards, correct assets in it. So that's why we are studying the scope of the property, plant, and equipment, and we are going to study the definition. So property, plant, and equipment are the tangible assets with the following properties. So tangible, non-current assets, and we know the tangible asset means which are having the physical existence. So what is the scope of the IAS 16? These are the assets held by an entity for use in the production. So when you talk about for the use in the production, that means the machinery. Say, for example, I'm having machinery which is producing the goods, and those goods are being sold in the ordinary activity of the business. So we are using those machines for the production, for the business use. Or supply of goods or services. For example, you have the delivery vans, which are going to deliver your products. For rental to others, for example, your business is rent a car arrangement, where you have the cars which is being given on the rent to the customers. For example, they need it for traveling, they need it for weddings, they need it for parties, whatever the case is. And your business is rent a car arrangement. You have the vehicles which are being given to the customers on rent, and they pay you the rentals, which is your ordinary activity of the business. And those cars are bringing the money to the business. Those cars are being used for the business. Or for administrative purposes. For example, when you see the office, we have many things within the office which are being used in the administrative purposes. For example, we have the laptops, we have the computers, we have printers, we have scanners, projectors, other fixture and fittings. There are many things which are being used in the business. So you need to understand the scope of the standard. So IAS 16 property, plant, and equipment are the tangible assets which are held by the entity for production. For example, the machinery. For example, the assembly lines. Like assembly lines are the full, plant and machinery, where there's this is a full plant where there are a lot of machinery is connected together. Supply of goods or services. For example, you have the delivery vans. For rental to others, such as the rent-a-car arrangement, even there are many other examples. For example, you have the heavy machinery such as cranes, such as bulldozers, which are being given to the companies for the construction purpose. You charge a rent for that daily or monthly, or for administrative purposes, whatever we have for the administration. And expected to be used during more than one period. So whenever you are classifying any asset within IAS 16, you need to make sure that this falls between this scope. That particular asset complies with the scope of the IAS 16. So then we have the recognition. And in the first lecture where we were doing the revision of the basic accounting, I describe you the definition of the asset, and hopefully you remember that. That whenever you are going to classify any resource as an asset, there is a criteria. You cannot classify every resource as an asset. You need to see the following factors. The first thing is the control. There should be a control. And I told you in accounting, we see the commercial substance, the economic reality rather than legal forms. It doesn't matter even if you are not having the legal title. If you're having a control, which means the risk and rewards, then that means it's your asset. So this is the control. And then we talked about the economic benefits. Economic benefits are probable that it will flow to the entity. And I told you that when you talk about the economic benefit, don't see it only in the terms of the cash inflows. It can be anything. For example, energy saving is even an economic benefit. Cost cutting is even an economic benefit. Producing more units is even an economic benefit. Being environmental friendly is even an economic benefit. So you do not need to see that only in terms of the cash inflows. So the control and economic benefits. And the third thing is that the cost of an asset can be reliably measured. The cost can be reliably measured. Cost can be reliably measured. Now we know when we talk about the assets are being presented, being shown, being recorded within the statement of financial position. Within the statement of financial position, there will be a main heading of the assets, and then you will be having the non-current assets, and then you will be having within non-current asset the property, plant, and equipment, and there is going to be a value in front of that. So say, for example, if you are not able to allocate a monetary value to a resource, then that cannot be called as an asset. Let's assume we have the machinery. We should know the value of it. Value can be anything. For example, it can be a cost, it can be a book value, it can be a market value. We'll talk about that later. But there should be a value. Similarly, you talk about regarding the machinery, the vehicles, anything, whatever you are being presenting within the property, plant, and equipment, there should be a value of that. And remember one thing, that these recognition criteria apply to the subsequent expenditure as well. Like for example, you are buying a building, right? And that building is a single story building. And then you are going to let it only has a ground floor. So let's take an example of the building. It is only a single floor building, single story. And now you're making another floor on it. It's a second floor, second story, second floor. Now, are we going to record that expenditure within the cost of that asset? Is it going to be an addition within the cost of that building which you initially purchased or constructed? Yes, because that double story, that another story, the entity has a control over it. They can use that story for whatever purpose they want to. That story is going to bring the economic benefits to the business, and whatever the expenditure is being done on that double story, the another story, can be reliably measured. So that means you initially bought the building or you initially constructed the building. That was the initial expenditure on it, and it does met the criteria at that time. And now you have constructed another floor on it, and it also meets the criteria of the asset. So you are going to capitalize that expenditure as well. When we say capitalize, whenever I'm going to say capitalize, that means that thing is going to be part of the asset cost. So whatever it is, either it is an initial expenditure, it should meet the criteria of the asset, or whatever it is, even if it is a subsequent expenditure, it should meet the criteria of that asset, definition of that asset. Okay, then we have another important point, which is commonly seen within the business. Smaller items such as tools may be classified as consumables and expense rather than capitalized. Like for example, we have like small tools such as we have the screwdrivers, screw jacks, testers. Sometimes we have the nails, screws, nuts, and bolts. So sometimes we have these type of tools. It can be anything, like you don't see it in terms of the screwdriver, screw jacks, and nuts and bolts. It can be anything. For example, we talk about the barber shop. There can be, for example, scissors, which are disposable scissors, the combs, the brushes. So smaller items such as tools, you're not going to capitalize that. You're going to treat that thing as the consumables. Like for example, whenever I'm teaching in the class, not online, in the campus, I have many things within the class which are consumable. For example, I have the board markers, which treated as the consumable. You're not going to treat that board markers as a non-current asset. We have the dusters, cleaners. So smaller items such as tools may be classified as consumables and expensed rather than capitalized. So you're not going to treat, but I'm not talking about, for example, the tool kits, like the huge tool kits. Within the toolkit, there are many things. So if that is the case, you're going to aggregate that complete kit and treat as one asset, such as the toolkit. For example, the tool kits. So there are many things within it. Just accumulate that, aggregate that, and make that one asset. And I'm not talking about, when I gave you the example of the barber shop, I gave you the disposable scissors, you have the brushes, the combs, which are treated as consumables. But I was not talking about this, about the blowers, the straighteners, the curlers. I'm not talking about those shaving machines, which are electric and they can be used for more than 1 year. So I was not talking about those things. I was talking about the smaller tools. And tools can be anything. Like, for example, for me, being a teacher, my tools are the board markers. For the barbers, they have the combs and brushes, etc. So when you have the smaller things, smaller tools, treat that thing as the consumables. And when you have, for example, the large stuff, like the blowers, colors, whatever, it can be anything. You just capitalize that. And sometimes when you have the kits, you treat that as one asset. Now we have the measurement at recognition, which is known as the initial measurement. This is known as the initial measurement. At what value initially you are going to record your asset? So the property plant equipment says that initially the asset should be recorded at cost, at its cost. Now, how you are going to define the cost? The cost has many components. The purchase price, at whatever price you are purchasing it, less discounts. For example, I went to buy a photocopy machine for my office, and they said the photocopy machine is for, let's assume, $500. And then I said, no, you need to give me some discount for it because I'm buying it for the office. And they said, okay, we are going to give it to you for $450. Now that $450 represents the purchase price of that photocopy machine. So purchase price less discounts and less rebates. Rebates are when, for example, there are duties which are being made off the rebates. It is a type of discount, basically. Including import duties, for example, I bought something from, let's assume, China, and I'm bringing it to my country. I'm going to pay the import duty on it, and such as non-refundable purchase taxes. That will be part of the cost as well. But for example, if the government, let's assume I'm buying an eco-friendly asset. The government says, initially you're going to pay the tax, but if the asset is eco-friendly and we confirm it later on, then all the tax will be refundable. In that case, the refundable taxes should not be made part of the cost of the asset. So purchase price, including the import duties and including the non-refundable taxes. In addition to that, you will be having directly attributable cost of bringing the asset to the working condition. For example, I bought a machinery from, let's assume, China, and I'm bringing it to my country. So I paid the purchase price of it. It should be capitalized. I paid the import duties for it. Now it's on the port. I pay the non-refundable taxes. Now it's on the port. I need to bring it to my company. I will be bearing the transportation cost, initial delivery or handling cost. Let's assume I'm going to install it, and for installation, I need to prepare a site for it. The site preparation cost. Someone will be coming to install that asset. Installation cost. Now I need a professional advice on it, how to use that asset. I'm paying for a professional fee that should be capitalized. Someone professional is coming to test it. That cost of testing should be capitalized, but that should be a one-off testing. Like sometimes, you're testing the machine yourself, and in testing, you're making the blunders. And every time you are bearing a loss on it, that should not be capitalized. I'm talking about a one-off testing. And there's a point related to that particular cost of testing as well. Let's assume, let's assume I bought a machinery, and that machinery is a laser cutting machinery, for denims, the jeans we wear usually, the denims. Nowadays, like, due to the artificial intelligence, everything is being getting automated. Although it's an old technology, but nowadays more common. You just need to give the pattern commands to the computers, that what pattern you need for the denims, and then the lasers will be cutting it for you. Previously, we used to have the humans for it. So artificial intelligence, it has a disadvantage of making people redundant. Anyways, it's a debate, whatever. So I bought a machinery which is being used to cut the denims. Now, I didn't know how to use it, so I called a professional to just show me how to use it, and we'll have it tested as well. So he said me, okay, I'll be coming to test it, and okay, I will be charging my fee of $1,000, and I am going to cut some denims for you, in which you can learn how to cut the denims and how to use the machinery. I said, okay. So the professional person is going to test that machinery, and he's going to charge you $1,000. And during the testing, let's assume he cut 5 denims, which can be sold. Let's assume one for $10. That the denim which is being cut from the machine, the laser cutting machine, can be sold. 5 denims can be sold for $50, and I'm in a position to sell that. I'm going to sell that. So I'm going to deduct that $50, which is the product being produced during the testing, which can be sold. I'm going to take the realizable value of it, whatever price it is going to earn. And this $950, which is the net figure, is going to be capitalized. So remember one thing, that if you're doing the testing, any professional is coming to test your machinery or whatever the asset is. And during the testing, you're going to make some production, and that those units which are being produced during the testing can be sold at some price, and you're going to sell it. So you can deduct that price from the cost of the testing, and whatever is the net amount, that should be capitalized. So employee benefit cost, for example, you're paying your employees for that particular asset, for installation, for constructing it, site preparation, initial delivery and handling cost, installation and assembly cost, professional fee, cost of testing. And then there is one most important thing within the cost of this, is the site restoration provision. And the site restoration provision is also known as the dismantling cost. So the restoration cost, this is also known as the dismantling cost. This is also known as the decommissioning cost. Decommissioning cost. These are the names of a single cost: restoration, dismantling, and decommissioning. Now, what is the idea behind this? The idea behind this is, let's assume you have installed an asset, whatever asset it is, and you are required to dismantle it at the end of its useful life, at the end of its project, or on the completion of the project, or the completion of the task. You are going to remove that asset, you are going to dismantle that asset, you are going to restore that site, you are going to decommission that thing, at the end of its useful life, at the end of the project, on the completion of the project. And whenever you are going to do this, there will be a cost associated to that. There will be a cost associated to that. And that is going to be the future value. That is going to be the future value. Let's assume after 5 years, I'm going to dismantle this site, dismantle this asset. And after 5 years, I'm going to spend some money to dismantle it, to restore the site, to decommission it. The standard says that you cannot capitalize the future value itself. You are required to calculate the present value first. Now, present value equals to, now this is something which you have studied in your management accounting paper, but if, for example, if you have forgotten that thing, no worries, I'm going to revise it. So how the present value is being calculated, you take the future value and then you multiply it by 1 plus R raised to power minus N. R represents the rate of interest, which is going to be given in the exam question. N represent the number of years, how many years, after how many years you're going to dismantle it. So present value equals to future value multiply 1 plus R raised to power minus N. And you just need to calculate it on the calculator, and sometimes it is being given in the exam question. Now, this portion is being solved within the exam sometimes, but many times you're going to calculate it. So how you can do it? You have the scientific calculators, for example, or for example, you have the built-in calculator within your CBE system, CBD system. You take 1 plus R, for let's assume it is 10%, so you take that into decimal, 0.1, 1 plus 0.1. And raised to power is the exponent sign. You can see exponent sign. This is the exponent sign you can clearly see on the calculator. You need to press that. And then minus N, number of years, for example, 5, 10, whatever it is. It is going to give you 0. Something figure. You can just take, for example, 0.926, go up to 3 decimals. 0.926, 0.825, 0.728, things like that. You just take 3 decimals. So present value equals to future value 1 plus R raised to power minus N. And you know, when we are bringing the future value to the present value, this process is known as discounting. Be attentive. This is a very important thing, and you can expect that thing in the exam. So be attentive. So future value, when you're bringing it to the present value, this process is known as discounting. When you're bringing future value to the present value, this process is known as discounting. Now, the idea is that you have installed an asset, you're using an asset, and you're required either contractual obligation or legal obligation, whatever it is. You're required to dismantle it. You're required to decommission it. You're required to restore the site after a certain number of years. Then this cost is a direct cost because it is being incurred. It will be incurred due to this particular asset which you are using. So it's a direct cost. And we have studied that any direct cost should be capitalized. So because you're using it and you have an obligation to dismantle it, then whatever the cost of that dismantling is, you need to make that cost part of the asset cost. So the double entry is going to be, now it is important to understand the double entry. The double entry is going to be debit cost. That means making that particular expenditure part of the asset cost, and credit provision for dismantling. Now, what is this provision for dismantling? It's actually a liability in the statement of financial position. Like after 5 years, you're going to dismantle it. So it's your obligation. And in the accounting terms, we call obligation as a liability. Now, why I'm not writing it as a liability directly, why I am calling it as a provision for dismantling. Like provision for dismantling means that provision is defined as a liability. Provision is a liability of uncertain timing, and amount. Provision is a liability of uncertain timing and amount. I know that after a certain number of years, I'm going to dismantle it, but maybe I do not have the correct idea exactly how much I'm going to spend it, how much I'm going to spend on this dismantling. So it's the uncertain amount. That is why we call it as a provision. And now you know from your accounting concept that you are going to make an account for the provision. You're going to make an account for the provision. So what you're going to do, the provision account is being debited due to the asset. This is the opening figure, and this becomes your closing balance. And in the next year, this is going to be your opening balance. So this is the first step. This is the first step to calculate the present value. And then there is another thing attached to it, which is known as unwinding. That is something very important to understand. But let me show you an example where we are just calculating the first part of it. Okay, the first example, if an oil rig, okay, so if an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value of the cost of dismantling it. Like, and if you're building an oil rig, which is going to extract the oil from the sea, we see it in many countries, they're doing that. Not every country are having reserves within the sea, but the lucky countries are having that. Okay, so if an oil rig was built in the sea, the cost to be capitalized is likely to include the cost of constructing the asset and the present value to dismantle it, because whenever you're extracting the oil, now it's your obligation to restore the site. You cannot leave that hole which we have made to extract the oil. You have to fix it. So if the cost of asset 10 million to construct, if the asset costs 10 million to construct and would cost 4 million to remove in 20 years, then the present value of this dismantling cost must be calculated. So you know the formula. I've already told you that if you need to calculate the present value, we take the future value 1 plus r raised to power minus n. Now the future value is 4 million, 40 lakh, 4 million. 1, 2, 3, 4, 5, 6, 6 zeros, right? 1 plus, now we need the interest rate. So it is being given. If interest rates were 5%, so, you know, in the decimal we take is 0.05, 0.05. 5 divided by 100, you get 0.05. Raised to power minus n, after how many years we are going to dismantle it? After 20 years, so we take minus 20. So first of all, as the maths rules states that, first of all, you need to solve the brackets. 1 plus 0.05. If you have the calculators, you can just check it. 1 plus 0.05, then press equal to sign. Then go to the go to the above keys. You will find the exponent figure over there. Press this figure and then minus 20. So the present value of 40 lakh 4 million is 15 lakh 7,558. The future value of the obligation is 40 lakh, but we cannot record that figure right now because it is going to be a misleading thing. So what you're going to do is you're going to present value of that obligation, and then you're going to debit the asset with the present value of 15 lakh 7,558, and credit entry goes to the provision for dismantling. So this is at the start of the year. At the start of the year, and now you're going to make an account which is provision for dismantling. This is something very important thing. That's why I'm going to make an account for it. So provision for dismantling account is being debited due to the asset. You know how to put the entry into the account. This is a provision account which is going to be credit, and we give the reference of the debit entry in the account. So debit asset due to asset, and this is 1507558. This is the first concept which I've already told you, that how to calculate the present value. So we are done with the initial part of this dismantling, that we have successfully calculated the present value, and we have got the figure which is 15,07,558. Now we are going towards the next concept, which is known as the unwinding, and I need your attention for that. Unwinding. What is this concept? Now we know that the financial statements are being prepared for the user of the financial statement. We already know that the financial statements are being prepared for the users. We have already discussed this thing in the introductory lecture where we were doing the revision of the accounting when we talk about the financial statements. So the financial statements are being prepared for the users of the financial statement, and those users are concerned. For example, you're talking about the statement of financial position. They are being concerned regarding the assets which are being shown within the statement of financial position, that they are not overstated. And then they are also concerned regarding the liabilities as well, that those liabilities are not understated. So assets should not be overstated and liabilities should not be understated. And we have already discussed that this concept is known as the prudence concept. Prudence concept says that assets should not be overstated and liabilities should not be understated. This was the concept we have studied earlier. All are fine. So what has unwinding to do with this financial statement and the users? What is the link between this unwinding and the users? Now, the original liability is actually 4 million, which is going to be incurred after 20 years. Now, if we keep liability throughout 20 years at this 15,07,558, if we keep the liability at this figure for the remaining 20 years, then we are going to understate the liability. Because the liability is actually not the 15,07,550, it's the present value now. The actual amount you're going to pay after 40 years is 40 lakh, which is 4 million. So systematically, we have to take this present value to its original value. So what we will be doing, like we have used this 5% rate for the calculation of this 5%, for the calculation of the present value. We are going to take the same 5% to take it back to the original 4 million amount. Now, how that is being done? You're going to take this present value 15,07,558, and at the end of the first year, you're going to multiply it by 5%. This will give you the figure of 75,378. And what you're going to do, you're going to take 15,07,558 plus that's 5%, 75,378. At the end of the first year, this figure is going to be 15,82,936. Then again in the second year, by the end of the second year, you're going to multiply. This was the first year calculation in the first year. In the second year, you're going to take again 15,82,936, and then you are going to add the 5% of it. Then it is going to give you the figure. Then again in the third year, whatever the figure is, you're going to multiply the 5% to it and then add that 5%. When you will be doing systematically this 5% thing, by the end of the 20 years, this figure will automatically reach 4 million or 40 lakh. So the first process was to bring the future value to the present value. This process is known as discounting. And then you are systematically taking the value to its original value. And every year liability is being increased by the same 5% which you used for calculating the present value. That same 5% is being added. And eventually after 20 years, this figure will reach 4 million. This process is known as the unwinding. Now the double entry to record the unwinding is debit profit or loss. And remember, this profit or loss is recorded in the statement of profit or loss as a finance cost, interest cost, because this is the same interest rate which you use for the calculation of the present value. Now you are taking it back to its original value. So you debit the profit or loss and credit provision. That provision is increased every year. So by the end of the year one, what is going to be the double entry? Debit profit or loss by 75,378 and credit provision for dismantling. So provision account is being debited due to the profit or loss, and the figure is 75,378. The closing balance of in the year one, which is this closing balance is known as the liability because provision is a liability, 15,82,936, which is going to be the opening balance of the year two, 15,82,936. Again, in the next year, you're going to take 5% and then add in it. Similarly, every year we'll be doing this activity, and this is known as the unwinding. So there are two things I'm going to recall. The first process is bringing the future value to the present value, known as the discounting. Initial double entry is going to be debit cost, credit provision. Make that present value part of the asset cost, and credit is the provision, which is the liability. Liability will be restated every year. And this process is known as unwinding. The double entry for unwinding is going to be debit profit or loss and credit provision. That means you're going to charge that interest expense within the profit or loss, and provision will be increased every year. Now, the important point to understand is that in the exam, examiner is going to ask you regarding the extracts of the financial statements. This is the most important thing. The calculation was easy. You just need to have the formula, and that's it. The extracts of the financial statements. Either the examiner is going to ask you what figure you are going to take within the statement of profit or loss, or they are going to ask you what figure you are going to take in the statement of financial position, or they can ask the both as well. So remember, in the statement of profit or loss, there will be two things. The first is the finance cost. And you know that this figure is actually the unwinding figure, debit profit or loss, the finance cost. The first figure is this, the finance cost, which we have calculated in the year one as 75,378, this figure. The second figure, which is going to be recorded within the statement of profit or loss, is the depreciation. Now, how the depreciation is being calculated? The cost of construction was 10 million, and then there was 15,07,558, or you can say 1.507 million. You're going to add this thing, and it's going to give you 11 million something. And then you depreciate it over 20 years. This is going to be the figure you will be having in the exam. So for example, if in the exam only this cost of dismantling is being given, then you can depreciate only the cost of dismantling. If you have the cost of other construction as well, then you're going to club it and then depreciate it. So in the statement of profit or loss, there will be two things. The first thing is the finance cost, which is on the unwinding. And the second thing is going to be the depreciation. So you need to remember these two things. When they talk about the statement of financial position, they're going to ask the assets carrying amount, the carrying value. So we know that the carrying value is the cost minus its depreciation. So the carrying value is easy thing. When they ask you the carrying value, so you take the cost of asset and deduct the depreciation for the year, then you get the carrying value. Or they are going to ask you the provision amount. And remember, when they ask you for the provision, we are going to tell the closing balance to them. For example, if they're asking the closing balance of year one, this is the balance. If they're asking the closing balance of second year, you're going to tell them the closing balance of the second year. So be aware of the extracts, what they are asking in the exam. If they're asking what figure is going to be in the statement of profit or loss, then you're going to tell them the two figures or a club figure of that, aggregate figure of that. finance cost and the depreciation. Finance cost is on the unwinding, and then we have the depreciation, which is the cost of asset divided by its useful life. When they ask you regarding the statement of financial position, it is going to be either the assets carrying value, which is cost minus depreciation, or the provision, which is going to be the closing balance. We have another example, and then we are done with this dismantling concept. So an entity builds a research center in the rainforest at a cost of 2,50,000. This is the cost of constructing the rainforest. Having signed a contract with the local government to dismantle the center and restore the land after 10 years at an estimated cost of 100,000. So they're constructing a research center in the rainforest. And the cost of that research center in the rainforest is 2,50,000. And they're going to dismantle it as well once they're done with the project. And the cost of dismantling is going to be 100,000. Now we know the formula. We take the present value is future value 1 plus r raised to power minus n. Future value is 100,000, and 1 plus r interest rate is 5%, so it's 0.05, and minus n number of years are 10. So the present value of this is 61,391. So the initial entry is going to be debit asset because we are going to make this expenditure part of the asset cost, and credit provision because it's a liability of uncertain timing and amount. So we are going to make an account of the provision, and we know how to put the entry. Provision account is being credited due to the debit entry, which is the asset. So give the reference of the asset, and initially 61,391. So the total cost of the research center is going to be the building cost, which is 2,50,000 plus the restoration cost, and total cost is 311,391. And we know this 311,391 is going to be depreciated over 10 years, and this is going to be the depreciation figure. The second concept is that we have to restate the liability every year by using the same percentage which we use for discounting. So 61,000 multiplied by 5%, it gives you 3,070. And the double entry is you charge that thing as a finance cost within the profit or loss, and you increase the provision by that. So provision account is being credited due to the profit or loss, which is 3,070. And then you are going to get the closing balance of the provision, which is 61,391 plus 3,070.